This is Nightly Business Report with Tyler Matheson and Susie Guerin. Brought to you in part by
TheStreet.com, featuring Stephanie Link, who shares her investment strategies, stock picks, and market insights with Action Alerts Plus, the multi-million-dollar portfolio she manages with Jim Cramer. You can learn more at TheStreet.com/NBR.
About face, stocks tumbled just one day after the biggest rally of the year, making this the most volatile stretch for the market since 2011.
Why now? And should investors like you get used to more ups and downs? Two experts share insight and advice on this volatile market. All that and more tonight on Nightly Business Report for Thursday, October 9th. Good evening, everyone, and welcome. Only 3 times this year has the Dow Jones Industrial Average lost 300 points or more. Today made 4, and the losses were the steepest of the year in point terms. All 3 of the broad market barometers fell 2%, this just a day after the largest one-day advance of the year. The bottom line, volatility is back, and the pros say it's not going anywhere anytime soon, so get used to it. Crude crumbled, investors fretted about slowing global growth, and the European Central Bank Chief Mario Draghi, speaking in Washington, signaled his worries about deflation.
We are accountable to the European people for delivering price stability, which today means lifting inflation from its excessively low level. And we will do exactly that.
Here's a look at the damage on Wall Street today, and it was thorough. The Dow plunging 335 points, the Nasdaq off by 90, and the S&P 500 down 40. The energy sector was especially hard hit as domestic oil prices fell another $1.50, closing below $86 a barrel for the first time since December of 2012. Brent crude dropped below $90 for the first time in 2 years. Bob Pisani has our report.
The issues dogging the market are essentially the same as what's been dogging it for the last several days. There's a collision between concern over slowing growth in the rest of the world and the debate between when the Fed should be raising interest rates. Several specific issues today. First, a slowdown in Europe. German exports dropped almost 6% in August. That's the biggest drop since the financial crisis several years ago. The head of the European Central Bank, Mario Draghi, again reiterated that there could be no recovery in Europe without structural and economic reforms. But a lot of traders are increasingly doubtful that the European leadership will be able to enact those reforms and get Europe back on a growth track. Third, there's been the relentless drop in oil. Good news for the economy, but very tough news for people who own oil stocks. Big oil names like Exxon, Chevron, Total, BP are down 3 to 9% just this month alone. Finally, there's general concerns about the ability to control the spread of Ebola, particularly if it spreads to other parts of the world like Southeast Asia or even Central America. Finally, though, let's try to keep a little perspective. The U.S. is not in a recession. The U.S. economy, in fact, is growing. The drop in oil is good news for us, and the S&P 500 is only about 4% from its historic highs, which it hit only about 3 weeks ago. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Well, those worries about a slowdown in the global economy were just one of the hot-button issues facing delegates at the International Monetary Fund and the World Bank meeting in Washington today. Carl Icahn has more.
The annual meeting of the IMF and World Bank are underway in Washington. Finance ministers, central bankers, and other financial heavyweights gathering to discuss global risk after the IMF cut its outlook for world growth this week.
For next year, we have revised down as well to 3.8%. So it is mediocre. That's what I call the new mediocre, but it is recovery.
A slowdown in Europe is front and center. The IMF says Germany must spend more to boost infrastructure, and the European Central Bank should be prepared to do more to boost growth and consumer prices. And while the U.S. is growing faster, leaders are still trying to solve lingering issues like stagnant incomes and inequality.
The issue of income allocation. Who is benefiting from growth and where is income going? How much inequality can systems bear for growth to continue to be sustainable? And we have a concern that if inequality continues to increase, then growth will not be sustainable.
Our people are dying.
Policymakers here are also discussing ways to fight the spreading risk of Ebola, after the World Bank says it could cost African nations as much as $32 billion by the end of next year.
The $32.6 billion is not because of the virus itself. 80 to 90% of that is the aversion behavior, the stop in productivity. People don't go to work, kids don't go to school, there's no flights coming in, trade slows down.
Bottom line, 6 years after the financial crisis, and the world is recovering, but that recovery is bumpy and it is fragile, leaving it vulnerable to economic hiccups, bad weather, and geopolitics. Wall Street has certainly taken notice. For Nightly Business Report, I'm Sarah Eisen.
Well, let's get more now on today's market sell-off. Spend some time with two guests. Chris Wolfe, he's Chief Investment Officer at Merrill Lynch Private Banking and Investment Group. And Aaron Gibbs is Equity Chief Investment Officer with S&P Capital IQ. Folks, welcome. Good to have you with us. Chris, let me begin with you. Why has volatility come back as strongly as it has? And is there anything individual investors can do about it?
Yeah, well, I think there's two reasons. One, it's just been a combination of factors, many noted before, from Draghi's speech today, coupled with the German miss in economic data. China recently has also been weak. And you've seen actually earnings revisions in the United States come down a little bit. So the long, good ride of kind of having your cake and eating it too, good returns with not a lot of volatility, given all of the fragile elements that I just described, seems to be kind of coming to an end. Now, that doesn't necessarily mean bad things. I think there's still good elements of what's going on in the fundamentals for investors in the U.S. CapEx is still picking up a little bit. Companies still generating a lot of cash. And while there are concerns that Europe is slowing down, many of the big multinational companies in the U.S. still have ways to manage their margins in order to generate strong cash flows. And I think individual investors in this environment kind of benefit from doing two things. First, being patient. Let this settle a little bit. We're coming into the earnings season, and there's likely to be a little bit more noise. Second, look for opportunities in higher quality spaces, because those will be the places that have that volatility around international risks building in them.
Aaron, let me just ask you a little bit more about this volatility. Why these sudden swings? Even from what Chris was saying, we've heard that rationale before about the fundamentals are pretty much the same. Concerns about Europe. It's the same conversation we've had all summer long. So is this the beginning of something different and something bad?
No, I still see this as very much within the normal range of volatility. And one more point. So up until recently, we've been trading at fairly high valuations. When we talk about PE, or price to earnings, we've been trading at about 16 times forward earnings, which is a little on the high side, above average, let's say. So when you start seeing these global risks come in, naturally, it's perfectly natural to have a bit of a pullback and a bit of a correction. But volatility levels are still well below 5-year averages. In fact, we still haven't even hit the volatility we saw back in February. So investors just need to have a slightly longer term memory and basically stick to their game plans, stick to long-term investing.
Chris, is this the correction so many have been warning about?
I think that's a good question. I think it's part of the correction I think investors have been looking for since the beginning of the year. Lots of statistics about how many days we've gone without a 5% move. And I think the last couple of days, at least around volatility, because remember, we've been down, then back up, then back down again, indicate that investors may be wanting to look at opportunities from a longer term perspective. To my point earlier, the bottom line around volatility being very low for so long, it set expectations maybe the wrong way, that this was the normal, always up and no volatility. And that's not how things are.
So, Chris, tell us, have you changed your investment strategy, and have you changed your outlook for the rest of this year and where the stocks averages are going to end the year?
No, our strategists really haven't made any changes to their forecast. I think what we're trying to ensure with clients is there's a balance of opportunities. We've been pretty bullish on some of the cyclical sectors earlier in the year. They've been hammered, actually, very recently. Some of the defensive names have come down as well. So for clients looking to reposition where they have new cash, it's more around the defensive lines. For clients looking for opportunities to kind of pick up a little bit of the U.S.-centric growth, it's more of those U.S. companies that benefit from U.S. growth, given all the risks we see developing in Europe.
Aaron, let me get you to react to what Chris just said. If you have things on your buy list, what are they, Aaron? Where would you be looking on these dips to buy?
So I have two companies, both that have mostly domestic revenues, because one thing that we are concerned about is this huge increase that we've seen in the dollar. It was actually up almost 8% over the past 3 months, which is a big change for just 3 months. So 2 companies that I like are Lockheed Martin, which is more of the defensive, very high quality dividend yield, just like Chris said. And the other one is Southwest Airlines, which has really picked up some great market share with the acquisition of AirTran Airlines. And this is one that we recommend buying on any dips.
Chris, just to wrap it up, I'm still I think like a lot of viewers watching this, wondering why is this happening now? To what extent does any of this have to do with what's going on in Washington with the midterm elections coming up? Is this related to that? Some nervousness?
Yeah, I think there's a little bit. I think a lot of times when you see big moves like this, it's often because a lot of dry wood was laid down and then a match was struck. In this case, I think the match was 2 things, really. The weak German data and Mario Draghi's speech at the Brookings Institution, where he talked about his speech in Jackson Hole, which said inflation expectations in Europe are unhinged, which is economists speak for, oh my gosh, this is a lot lower than we thought. We're going to have to do a lot more than we expected. That was a surprise to markets. That's the match that I think got people reassessing whether or not the European growth story is as strong as expected next year. Put the IMF lowered forecast in that mix, and I think you get a reassessment of how strong growth will be next year. That's a corporate revenue line issue, which means it's probably a little lower than people anticipate. Right. Markets adjusting to that.
Chris, thank you very much. Aaron, thank you as well. You helped us out a good bit tonight. We appreciate it a lot.
Thank you.
Well, here's something else that added to the market worries today. Strong words from the president of the St. Louis Federal Reserve Bank about investors making a big mistake on the timing of interest rate hikes. James Bullard said he was concerned about the, quote, disconnect between when investors expect the Fed to begin raising rates and when the Fed itself actually plans to do so. Bullard said that when there is a mismatch in thinking, it doesn't end well. Those are his words.
Well, he should just tell us when they're going to do it, right? That's it. We got to end it right there. Despite today's sell-off in the markets, one of the few stocks ending higher today was Apple. Shares there up 0.25%. That's not much, but when the rest of the market's down 300, it is. That comes after another round of pressure from a well-known activist investor about what Apple should do for shareholders like him with its massive pile of cash. Josh Lipton has more.
You can say this about Carl Icahn. He's consistent. The billionaire investor has repeatedly urged Apple to buy back more of its stock. This morning, he was at it again. In an open letter to Apple's CEO Tim Cook, Icahn first praised Cook as the, quote, ideal CEO. Then the activist investor told Cook what he's doing wrong. Icahn says that Apple shares are massively undervalued and worth $203 a share, 2 times the current price. He says the company should buy back more stock.
Nobody's smart enough to know when do you buy at the bottom and when don't you. And, hey, I'm not telling Apple go spend $100 billion tomorrow and buy the stock. I am saying this is a great opportunity to buy this company. And, hey, I'm not going to pick the day you buy it.
In response to Icahn, Apple says it's already aggressively executing the largest capital return program in corporate history. On July 22nd, when Apple last reported results, the company said it had returned $74 billion to shareholders. It plans to return $130 billion. So what's Icahn's real motivation here? Analysts say the activist, who owns 53 million shares of Apple, obviously wants to see the stock move higher. Buybacks could help.
I think the simple biggest motivation for the letter is that Icahn is fearful that investors are going to sell Apple shares after the big iPhone 6 release quarters. And ultimately, he's trying to lay the groundwork that this is a story to own for the longer term.
While Munster doesn't see the stock going as high as $203, he does agree with Icahn that Apple should buy back more stock, and he says that could be announced next spring. But he says Tim Cook probably won't be looking to Icahn for guidance about when or how to return more cash to shareholders. For Nightly Business Report, I'm Josh Lipton in Silicon Valley.
And still ahead on the program, General Electric's big bet on what it believes will drive the future of manufacturing. That story right after this. General Electric has a vision for the future of manufacturing, and it's launching a new initiative to hopefully get ahead of it, save money, and improve efficiency. Its goal? To get some of its biggest industrial machines to communicate with each other. Morgan Brennan tells us how.
General Electric calls it the industrial internet, the integration of software and sensors with big machines like airplanes, turbines, or locomotives.
If you went to bed last night as an industrial company, you're going to wake up in the morning as a software and analytics company. That this notion that there's a huge separation between the industrial world and the world of digitization, analytics, and software, those days are over.
GE has created an operating system called Predix to automate industrial machinery, working with partners like AT&T, Verizon, Intel, and Cisco to increase productivity and cut down on waste.
You know, if you look at a wind turbine, what we're doing is using software and analytics coupled with a lot of data about the wind speed and things like that, and we're optimizing individually each wind turbine in a farm, and we're finding we can generate up to 4% more electricity.
GE began developing the industrial internet 3 years ago, and today at its annual Mind and Machines event held in the building behind me, it announced that this new business will generate more than $1 billion in revenue in 2014. Still a small fraction of the company's overall sales, but one that analysts expect to grow dramatically over the long term.
You're talking about something that's a percent of GE's industrial business at this point. But the opportunity is enormous. And I think the question is not whether there's an opportunity, but how are they going to take advantage of that opportunity over time? How are they going to monetize that opportunity?
An estimated 50 billion machines and devices will become automated by 2020, and not just by GE.
I think you could say that most of the large industrial companies are trying to find ways to take advantage of this, and everybody is doing something.
Companies like Rockwell Collins, Honeywell, and Emerson are all investing in the space as well. But there are risks. Growing concerns over cybersecurity, which these companies say they are working hard to address, and the possibility that more productive machines could lead to less demand for replacements in the future. For Nightly Business Report, I'm Morgan Brennan in New York City.
Shares of a beverage giant bubbled up to an all-time high before, well, you know what they did? They fizzled out. They had to, and that's where we begin tonight's market focus. PepsiCo raising its full-year earnings forecast and its quarterly profit. They beat Wall Street expectations. The company says its snack sales, which include brands like Frito-Lay, helped lift earnings last quarter. PepsiCo has been urged by an activist investor to spin off the snack business from the sluggish beverage unit. Shares ended a third of a point lower at $93.57. Endo International is buying Auxilium Pharmaceuticals for more than $2.5 billion. The deal values Auxilium at $33.25 a share. That's a 12% premium over yesterday's close. But it was a rough day for Endo today. It was 6% lower at $66.78, but Auxilium up 9% to $32.44. And Kindred Healthcare is buying Gentiva Health Services for nearly $2 billion. Gentiva provides home health and hospice services. Both shares of both companies ended higher today. Kindred was up $1 a share. It finished at $20.75. Gentiva up nearly 17% to $19.49.
Allergan is raising its earnings estimate for the third quarter. The maker of Botox says the outlook shows the current takeover offer from Valeant undervalues the company. It's been reported that Valeant may raise its bid. Shares of Allergan fell, though, 1.5% today, closing at $187.55 apiece. Amazon, the 800-pound gorilla in online retail, now wants to open its first brick-and-mortar store. According to Dow Jones, the site will open in Manhattan right across from the Empire State Building in time for the holiday shopping season. The store would also reportedly function as a mini warehouse with limited inventory for same-day delivery right within New York City. The stock lost more than 2%, closing at $315 and change. Symantec is the latest company to split up. After the closing bell, the tech firm, which is best known for its Norton antivirus software, said it will form two publicly traded companies. One will be focused on software sales, the other on cloud data storage. The stock initially rose on the news in the late-day trading, but then finished the regular session down about 2.5% to close at $23.44. Mixed quarterly results after the closing bell from Family Dollar. The discount chain reported better than expected revenues as same-store sales edged higher, but a slight miss on earnings per share. The company didn't provide forward guidance because of its pending acquisition by rival Dollar Tree. In today's trading, Family Dollar up 4 cents a share, closing at $70.75.
A warning for any of the millions of Americans with an account at Fidelity Investments, one of the world's biggest mutual fund companies, 401k servicer. The Financial Times reports that Fidelity is among the financial institutions that got hacked by the same cyber thieves who breached the servers at JP Morgan Chase. But the paper says there is no indication that any Fidelity customer data was stolen.
Bond king Bill Gross sounded upbeat today as he held his first conference call and webcast since his sudden departure from PIMCO last month. Speaking from his new office at Janus Capital, Gross says stocks are not in a bear market, but he says investors need to, quote, recognize that times have changed. He expects stock gains of as much as 5 to 6% over the next couple of years and 3 to 4% for bonds.
Still ahead, it's Ben Bernanke's turn. The former chairman of the Federal Reserve took the stand and faced tough questions about the bailout of the insurance giant, AIG.
Home equity loans are on the rise. More homeowners, especially those who bought at the bottom of the market, are tapping into the equity built up in their homes. Realty Track reports the number of homeowners opening home equity lines of credit in the 12 months ending in June rose 21% compared to a year ago. And here's a story from the Where Are They Now files. It's been 6 years since anyone's heard from Dick Fuld. He's the former CEO of Lehman Brothers, the investment bank that collapsed at the height of the financial crisis. Well, Fuld is reportedly back and doing deals again. His new firm, Matrix Advisors, is advising a small investment company called Open Match Holdings to acquire the National Stock Exchange. The 130-year-old exchange shut down in May because of low trading activity, but Fuld is helping Open Match to reopen it.
Familiar names from the financial crisis were on the stand today at former AIG CEO Hank Greenberg's trial against the government over the terms of the insurance giant's bailout. Former Treasury Secretary Timothy Geithner ended his testimony while former Federal Reserve Chairman Ben Bernanke began his. Mary Thompson has more from Federal Claims Court in Washington. Mary, what happened in court today?
Well, you know, it was interesting to watch Bernanke's testimony today, Tyler, because he appeared vaguely annoyed and slightly combative when he took the witness stand. He replied to the questions from the lead plaintiff's attorney, David Boyce, with curt answers like, yes, sir, and I don't recall. But he did defend the government's actions with the AIG bailout, saying the tough terms of the $185 billion rescue package were needed to compensate taxpayers for the risks that they were taking and to minimize any windfall that shareholders may have received because of the government's actions. Bernanke was on the stand for about 2.5 hours today. He returns to Federal Claims Court tomorrow for more testimony. Susie?
Yeah, Mary, David Boyce spent a lot of time when he was grilling Bernanke on the equity portion of the bailout. Tell us what that was all about.
Well, this is key to the shareholders' lawsuit. They say that their Fifth Amendment rights were violated when the government didn't adequately compensate them for what became a 92% stake in AIG that the government took. So Boyce was repeatedly asking Bernanke, why did you take this equity stake? Did you know that a loan rate in 2008 included equity? Bernanke said no. Loan rates only include interest rates. So Boyce pushed him. But what about this equity stake? He said it was taken in order, again, to protect taxpayers who were assuming so much risk.
Boyce has had 3 big names in court this week, Bernanke and the former Treasury Secretaries, Mr. Paulson and Mr. Geithner. What is it he's trying to show the court with his questioning? Where is he going?
What he is trying to do, Tyler, is paint a picture of a government or government officials that really didn't do proper analysis on the value of AIG and its subsidiaries and and as a result, they put together this kind of slapdash agreement. They didn't ask the proper questions. They didn't seek any kind of outside analysis, when they put this rescue package together. So that is what Boyes is trying to show, that the government, when it had these excessive powers to use, they did not use the proper due diligence to create a rescue package that, again, did not treat the AIG shareholders fairly.
All right, Mary Thompson, thank you very much. Mary reporting from Washington tonight.
And from Washington to Wall Street, we recap our top story, a massive sell-off in the markets, the worst day of the year for the major averages on worries about the global economy, and after a sharp drop in oil prices sent energy stocks lower. The Dow tumbling 335 points, the Nasdaq falling 90, and the S&P 500 losing 40 points.
And before we go, Fortune magazine out with this year's 40 under 40. It's their list of the most powerful and influential and important and bigwig people in business under the age of 40. At number 5, Jan Koum, co-founder and CEO of WhatsApp, which was just acquired by Facebook for $19 billion. At number 4, Andrei Kobolyev, head of Ukraine's state-owned oil and gas giant. In third, Matteo Renzi. He's the prime minister of Italy. In second, Facebook founder Mark Zuckerberg. And a tie for number 1 between Travis Kalanick, the brains behind the ride-sharing app Uber, and Brian Chesky, the man who started the home rental app Airbnb.
We didn't give everybody's ages, but the prime minister of Italy is 39.
39.
Isn't
Just
that
gets in
amazing?
under the wire. And not really a business guy. He's a government guy. Come on.
That's Nightly Business Report for us. I'm Susie Garrow. Thanks for watching.
And I'm Tyler Mathisen. Thanks from me as well. We'll see you back here tomorrow night.
Nightly Business Report has been brought to you in part by
TheStreet.com, featuring Stephanie Link, who shares her investment strategies, stock picks, and market insights with Action Alerts Plus, the multi-million-dollar portfolio she manages with Jim Cramer. You can learn more at TheStreet.com/NBR.
I'm Susie Garrow with a Nightly Business Report news brief. A massive sell-off on Wall Street today as the Dow Jones Industrial Average posted its steepest loss of the year. Investors dumped stocks on concerns about global growth and the continued slide in crude oil prices, which slammed the energy stocks. The Dow plunged 335 points, the Nasdaq fell 90 points, and the S&P lost 40 points. In the oil markets, crude prices closed below $86 a barrel for the first time in nearly 2 years. But there was some good economic news today. Mortgage rates are down to the lowest level of the year, and jobless claims hit an 8-year low. And just ahead of the holidays, Amazon will reportedly open up its first ever brick and mortar store right across from the Empire State Building in New York City. Be sure to tune into Nightly Business Report right here on your public television station.